This chapter should give you an idea of what financial management is all about, including an overview of financial markets in which corporations operate. So, in this chapter, we're going to cover forms of business organization. We'll also talk about objectives of the firm, that is to maximize value. We'll also talk about the determinant of fundamental values, and we'll also look at the financial security markets and institutions that ensures the business functions properly. So let's get started with the forms of business organization. And before we go further, why is corporate finance important to all managers? Because it provides the skill managers need to identify and select the corporate strategies and individual projects that adds value to their firm. So we'll see in the later part of the course the capital budgeting technique and various tools and techniques in the course, which will help managers to select the best alternative that will add value in the firm, that will contribute in maximizing the wealth of the shareholders or stakeholders. And that also helps the managers to acquire the skills that they need to forecast the funding requirements of their company and devise the strategy for acquiring those business. So let's begin with the different forms of organization. One is sole proprietorship, the other one is partnership, and the last one is corporation. The sole proprietorship, which is kind of an unincorporated business owned by one individual. The proprietorship has one of the good advantages is that it's easy to form, all right, and is inexpensive to start. Is relatively few government regulations, and it pays no corporate income tax on profit. Instead, they are included in the proprietor's personal income. However, there are three disadvantages. One is has limited life, unlimited liability, and difficult to raise capital to support the growth. So the proprietor has unlimited personal liability in the company for the business debts, which can result in losses that excess the money invested in the company. So he is personally liable for all kind of losses that results or that exceeds the money that go beyond the money invested in the company. The other form of business organization is the partnership, and partnership has roughly the same advantages and disadvantages as a sole proprietorship. Partnership exists whenever two or more persons or entities associate to conduct a non-corporate business for profit. And regarding liability, partners potentially can lose all of their personal assets in the event of bankruptcy because each partner is liable for the business debts. And to avoid this, we have limited partnership where the limited partners can lose only the amount of investment they contributed, while general partners have unlimited liability. You might have heard about limited liability partnership and limited liability company, where all partners' potential losses are limited to their investment in the LLP. We have another form of organization, which is corporations. Right, because the sole proprietorship and partnership have difficulty attracting substantial amount of funds, capital to support the growth. So there's many growth companies begin as a small proprietorship or a small partnership, but then subsequently convert into a corporations. So a corporation is a legal entity separate from its owners and managers. So managers are the agents and the owners are the supplier of fund, and those are stakeholders and the bondholders or debt holders. So the firm, there is the separation of ownership. At the same time, there is a possibility of agency conflict. It means that the agent of the firm may not act, may not act in the best interest of the owners who provide the funds. And in order to control their ownership interest. We have corporate governance, which establishes a set of rules so that agency conflict can be avoided. While the corporation, that's why has three major advantages. One is unlimited life, another is easy transfer of ownership interest, and third is limited liability. Corporation, it is costly to form in the sense that it requires, it involves preparing a charter and writing a set of bylaws. And another disadvantages could be corporate earnings may be subject to double taxation. The earnings of the corporations are taxed at the corporate level, and earnings paid out as dividends are taxed again as income to the stockholders. So the charter is what is charter? Charter includes the following information, like the name of the proposed corporation, types of activities they are going to pursue, amount of capital stock, number of directors, name and address of directors. So the charter is filed with the Secretary of the State, in which the firm will be incorporated, and when it is approved, the corporation is officially in existence. Where the bylaws are a set of rules drawn by founders of the corporations, and bylaws specify how directors are to be elected, whether the existing stockholders will have the first right to buy any new shares the firm issues, and the procedure for the bylaws and charter. And there are several type of professional several type of corporations and professionals such as doctors, lawyers, and accountants often form a professional corporation or professional association. Finally, some corporations can elect to be taxed as if the business were a proprietorship or partnership if the corporation meets certain requirements regarding size and number of stockholders, and such firms are called S corporations. Corporations are growing. Corporation needs fund, and going public is called initial. And in most cases, an investment bank such as Goldman Sachs helps with the IPO by advising the company. In addition, the investors, bankers, company usually is a broker firm which employs brokers who are registered with the SEC, Security and Exchange Commission, to buy and sell stocks on behalf of clients. And these brokers help the investment bankers sell the newly issued stock to the investors. And if a company wanted to issue, wanted to raise capital using subsequent issue of debt and equity, that is also possible, and they can raise the capital is known as seasoned equity offering, which is that a public company raises more funds by selling an additional shares of stock and through seasoned equity, which is much simpler than the original IPO. Okay. And as I talked about the agency problem and corporate governance, right? So what should be the primary objective? So the primary objective should be shareholders' wealth maximization, and which translates into how to measure the shareholders' wealth maximization is maximizing fundamental stock price. So fundamental stock price is intrinsic value of the firm, intrinsic value of the stock. By behaving ethically, at the same time, do not shirking from the responsibility to a society. So maximizing stock price and maximizing wealth is considered to be the objective of the firm, because that tries to maximize stock price, right? That maximizing stock price, put it in a different way. So because when a company tries to maximize the stock price, that will help in generating employment, increasing welfare, and at the same time help the society to grow. So that should be the main objective of the firm, because that leads to It is good for society, employees, and customers because no company stock price can grow for a long period of time without any solid and concrete reason. So if it is company is doing good for society, is doing good for employee, and is doing good for customers, all the positive expectations are reflected in the market price of the share. So what company gonna maximize? Is company gonna maximize their intrinsic value, right? Maximizing intrinsic value or investment value or the stock value. How the intrinsic value is determined. So one of the factors that helps in determining the intrinsic value is the free cash flow. So the cash flow is that is generated from the business operations. So the three things that contribute in that affect the investment value about the cash flow is the amount of cash flow that is bigger the better, sooner the better, and less risk is better. So what is the cash flow? The cash flows are the cash flows that are available for distribution to all investors, and they are stockholders and creditors. And free cash flows are defined as sales revenue minus operating costs, operating taxes, and any required investment in operating capital that you subtract. We'll see deeper about the free cash flow in chapter 2. And as you know, the third part is risk of the cash flow, right? Timing of cash flow, earlier the better. At the same time, the risk of the cash flow. So each cash flow, intrinsic value of the firm is the sum of all future cash flows, expected future cash flows when converted into today's dollar term. So that is discounted with the risk factor, which is WACC, weighted average cost of capital, and we're gonna talk about weighted average cost of capital in later chapter. So this process is known as discounting, and discounting is also one of the key idea of time value of money. So the intrinsic value, this is the big picture. The firm generates the cash flow. So higher the cash flow, higher the value of the firm. Less the risk, higher the value of the firm. Earlier the cash flow, better for the firm because the firm can use the cash flow to invest somewhere and can earn a greater return on their investment. All right, so the weighted average cost of capital, as I talked to before, that firm require capital to meet their requirement, and they raise the capital through debt and equity, and each component has its own cost, and that is the cost is a return demanded by equity shareholders and debt holder in exchange of the funds, or in exchange for the funds they supply to the company. So it is important that if the risk is minimum, value of the firm will be more. Okay, so firm requires capital, and how the providers and suppliers of the fund meet together and will serve meet together and how they provide the funds, the providers of the funds and users of the capital. So who are those users and providers? So households are the net savers. They are the providers of capital as a non-financial corporations. Are the net users, are the borrowers. Governments are net borrowers. Some foreign governments are net savers, and financial corporations slightly net borrowers but almost break even. And this is the flow of funds, capital allocation process between borrowers and suppliers. So the providers provide funds to the business by borrowing business securities, and then that will give will be returned to the providers in the form of for equity shareholders in the form of dividends, for the bondholders in the form of coupon payment, and etc. Investment bank also the providers provide the funds to the business, and they sell securities, and then the investment bank securities to the then business securities to the providers, and the capital allocation process through financial intermediaries. So we have three types of capital allocation process. One is direct transfer, through investment bank and through financial intermediaries. So the direct term transfer is the corporation issues commercial paper to insurance company through an insurance banking house, like an IPO or season equity offerings. Company sells securities to investment banking house, with then sell securities to the investors, and financial intermediaries, like an individual deposits money in the bank and gets certificate of deposits, and bank makes commercial loan to the company out of the money being deposited to them. And since the money is what corporation wants is, like I told you, the cost of capital. Well, lower the cost of capital, lower the risk, and that that enables the company to maximize the price of the share or the maximizing intrinsic value. Right. So what we do call the price, a cost of debt capital, is an interest rate. What we do call price for cost of equity capital is dividend yield and capital gain, because cost of equity is the required return, right? And this required return is in the form of dividend the company pay and also capital gain, because once you invest in the company, you expect the price of the stocks to go up, and at the same time, you expect some form of return from the company that is in the form of dividend. So expectations of return, capital gain, and dividend, that forms the component of cost of equity. And for debt capital, so as your bondholder, the interest rate on debt capital, company borrow from the loan from the bank, and they pay the interest rate to it. Right? They get the capital from the bondholders, and they pay the coupon payment to them. So that is the cost of money. And there are different for factors that affect the cost of money, and you wanted to keep the cost of money to minimum. If there's a risk, more is the cost of money. Like in pandemic, COVID-19, right? The risk is more, so the cost is borne by the company. The risk is there, so the cost of money is more. And in order to mitigate the risk, government come up with interest-free interest. They lower down the interest rate so the people can borrow and invest in the economy, and economy get the stimulus. Right. Time preference for consumption is also affecting the cost of the money, because if you don't have the time preference for consumption, then probably you will save more for future. Production opportunities, if there is a less production opportunity, that affect the cost. And also the expected inflation. In inflation, the cost is more because everything is costlier. Federal Reserve's policy that will affect the cost of money, right? Like the stimulus that the Fed Reserve announced in the form of lowering down the interest rate that help the company to borrow the money at a cheaper rate that will bring down the cost of debt, right? So the budget deficit also increases the cost. If you have surplus, then reduce the cost of money. Level of business activities in recession or boom, right, that affect the cost. And international trade deficits and surpluses also affect the economic conditions. Those affect, if the country has more deficit, then the cost will be more, right? Because country need fund, right? So they might impose a tax, right, in order to collect it. As a result, the business become costly. So that increases the cost of getting money. Financial securities are numerous kind of financial securities. So you have derivatives market, option, future, and forward contract. For debt market, you have T-bill, commercial certificate of deposits. You have Eurodollars and Fed funds. In capital market, you can have a different form of bonds, stocks, and credit swaps. Right. So the capital allocation transfer used to financial institutions also play an important role in transfer of funds to a commercial bank, investment bank, savings and loans, mutual savings bank, and mutual funds. You have pension fund and hedge funds. So there are different types of markets. So there are some types of market with physical assets versus financial assets. I'm sure you know. Spot versus future market, money versus capital market, market for short-term securities, market for long-term funding, long-term securities. So the maturity may be less than 1 year here, maturity may be more than one. Primary versus secondary market. So in the primary market, companies issue their new stocks, and that stocks are being bought and sold in the secondary market. Right. Physical assets are the market for the physical assets, and financial assets are those stocks. Spot versus future are where the securities are being traded, and future markets are kind of in derivatives, but the price of an asset depends on underlying securities price. So that is an option is kind of a derivative market, right? Where the price of an option depends on the price of a stock, right? Right. So there is different types of market. As we discussed more on primary earlier, is a new issue market, and secondary market is existing market where buying and selling of firm share will take place. By location, the trading procedure can be classified on the basis of location and by the way that orders from buyers and sellers are placed. On the basis of location, a physical location exchange where trading is face-to-face, right? Or through computer or telephone networks. And by the way of orders, open outcry auction where face-to-face trading takes place. Dealers make buy from and sell to clients, and automated trading platforms where orders are being matched and executed automatically. And the types of orders usually give instruction to the brokers or maybe market order, because the market orders, that means that transact as quickly as possible at current price. And limit order is transact only if specific situation occurs. For example, if buy drops by $50, you sell it. Now, through the broker and dealer network, buying and selling take place, and they are essential because they provide secure liquidity to it. So they are registered with SEC, Security and Exchange Commission, but less regulated than alternative trading system and registered stock exchange. Broker-dealer purchase stock being offered for sale by a client and then immediately sell it to other client and who wish to buy the stocks. So the broker-dealer is counterparty to each other's contract, and that process is called internalization, and they have to report the transaction but not any information prior to the trade. So the trade in broker-dealer network are called off-exchange or over-the-counter, and those trades can be with individual or with institutions, and those trades can be large trades, and 10,000 shares or more are called block trades and are sometimes also called upstairs trades. So the shares or the trading more than 10,000. There's also an alternative trading system where broker dealers then register with SEC as an alternate trading system. One is that ATI has an automated trading platforms to match orders from clients, and ATIs must report trades, but not only pre-trade, but not any pre-trade information. So pre-trade information is not being reported. So that's why ADS is called the dark pools, and the stocks can only be listed at a registered stock exchange, and it could be maybe traded elsewhere. And once they are registered with the stock exchange, must comply with more regulations and must report the trades and pre-trade information like bids and ask price. And there are different type of stock exchanges in the United States. We have NYSE, New York Stock Exchange, and NASDAQ. We have S&P 500. We have Russell 3000, and so on and so forth. This slide shows the number of trading volumes and the shares and the number of companies being listed on in each of the state stock exchange. So that's all about from this first chapter. So the first chapter talks about what corporate finance is about, and what should be the goal of the firm is to maximize the value, and how the firm can maximize value by maximizing the market. How do you capture the firm is maximizing wealth is that by knowing that that can be quantified if the stock price of the firm is maximized. And in order to maximize stock price, the intrinsic value of the firm depends on free cash flow and the cost of the money, right? Or you can say the cost, the risk. So the main big picture here is intrinsic value of the firm depends on free cash flow. Bigger the cash flow, better the intrinsic value. Earlier the cash flow, sooner the better. and also less risk is good. So we'll see in the next chapter how to estimate the free cash flow, which form the base of firm intrinsic value. We'll also analyze, the free cash flow. We'll also try to learn how the stock cost of equity shares and cost of bond is being determined, because that is the main thing in discounting free cash flow, that ultimately related to the intrinsic value of the firm. Thank you.